July 18, 2025. Inside a sealed conference room at the People's Bank of China headquarters, the air is dry, filtered, almost sterile. The faint hum of climate control systems mixes with the soft tapping of leather shoes on polished stone floors. No cameras, no phones, no transcripts. Just a long table, a wall of screens glowing with red and green numbers, and a silence heavy enough to feel physical. On one screen, U.S. Treasury yields ticking higher by the minute. On another, the dollar-yuan exchange rate, flickering like a heartbeat monitor. On a third, a single number, immense and unforgiving. $3.2 trillion. 3.2 trillion US dollars. It is not a budget line, not an investment portfolio, not a bargaining chip casually tossed onto the table of geopolitics. It is the accumulated financial gravity of 40 years of global trade, currency policy, and strategic compromise. And in this room, everyone understands the unspoken truth. If this number moves too fast, the world moves with it. For decades, a simple question has echoed through financial media, academic journals, and political backrooms. What if China dumps the dollar? What if Beijing sells its U.S. Treasuries, abandons American assets, and pulls the pin on what some have called the ultimate financial weapon? The scenario is usually described in apocalyptic terms. The dollar collapses. Interest rates explode. Wall Street freezes. The American economy implodes. It sounds like leverage. It sounds like power. But power, in complex systems, often hides a paradox. And the paradox at the center of this story is both unsettling and profound. China cannot dump the dollar, because doing so would wound itself faster than it wounds the United States. The $3.2 trillion is not a weapon aimed outward. It is a mechanism pointed inward. A financial structure so deeply embedded in China's economic rise that removing it would unravel the very system that created it. To understand how the world arrived at this moment, this quiet standoff measured in basis points and currency swaps, we must rewind the clock. December 1978. Beijing. Deng Xiaoping steps forward as China's paramount leader, inheriting a nation exhausted by revolution, isolation, and economic stagnation. His vision is radical in its simplicity. China will open itself to the world. It will manufacture. It will export. It will trade ideology for growth. What follows is one of the most consequential economic transformations in human history. Factories rise along the Pearl River Delta. Ports expand. Millions leave farms for assembly lines. And with every container ship that leaves Chinese docks, loaded with toys, textiles, electronics, machinery, something flows back in return. U.S. dollars. At first, the dollars are merely a means of settlement. But as trade surpluses grow, they accumulate faster than China can spend them. Beijing faces a problem few developing nations ever encounter: too much foreign currency. The solution seems logical, even prudent. China recycles its dollars back into the United States, buying U.S. Treasury bonds. Safe, liquid, trusted. In doing so, China keeps demand for the dollar high, suppresses the value of its own currency, and ensures its exports remain cheap and competitive. A loop is formed. Exports create dollars. Dollars buy treasuries. Treasuries keep the yuan weak. A weak yuan fuels more exports. It is elegant, efficient, self-reinforcing, and dangerously irreversible. By the early 2000s, this system has matured into a symbiosis. The United States consumes. China produces. American households buy inexpensive goods. Chinese factories operate at full capacity. Wall Street provides liquidity. Beijing provides savings. Two vastly different political systems become financially interdependent, locked together not by treaty, but by balance sheets. Key figures shape this architecture. U.S. Federal Reserve chairs who prioritize liquidity and low interest rates. Chinese central bankers who perfect currency management. Trade negotiators who widen supply chains while narrowing domestic resilience. Each decision, rational in isolation, compounds into a structure no single actor fully controls. Then come the shocks. 2008. The global financial crisis exposes the fragility of the system. The United States prints trillions to stabilize markets. China watches closely and learns. The lesson is not that the dollar is weak, but that it is indispensable. When panic strikes, the world still runs toward U.S. Treasuries, not away from them. China doubles down, then quietly begins to rethink. Gold purchases increase. Alternative payment systems are drafted. Currency swap lines appear with distant partners. Treasury holdings peak, then slowly decline. Not an exit, a repositioning. Because by now the trap is clear. China's dollar holdings are no longer just reserves. They are collateral for its banking system, pricing anchors for its currency, and implicit guarantees behind its export economy. Selling them too quickly would collapse asset values globally and wipe out China's own savings in the process. It would strengthen the yuan at the worst possible moment, crush exports, trigger corporate defaults, destabilize banks, force monetary expansion at home. The very act meant to punish an adversary would boomerang inward. This is the central paradox of modern financial power. The deeper you are embedded in the system, the less freedom you have to attack it. And so, in that sealed room in Beijing, the question is no longer whether China should dump the dollar. The question is how long this balance can hold. Because outside, the world is changing. Supply chains fragment. Trade becomes strategic. Sanctions turn currencies into tools. Trust erodes. Every percentage point, every billion moved, every agreement signed in silence adds pressure to an already strained equilibrium. What was once a growth engine now feels like a containment chamber. This documentary is the story of how that chamber was built, step by step, decision by decision. How two rival superpowers became financially inseparable. How leverage transformed into liability. And why the most feared move in global finance may be the one no one can afford to make. The trap is real. The numbers are real. And the consequences, should the balance break, will not remain confined to Beijing or Washington. They will reach everywhere money flows. And in a system this interconnected, there are no spectators, only participants who haven't yet realized they're inside. The machine that built the trap, 1978 to 2001. The story does not begin with conflict. It begins with convergence. In the late 20th century, two economies, opposites in ideology, structure, and political philosophy, found themselves solving each other's problems. The United States had consumption. China had labor. After Deng Xiaoping's reforms in 1978, China opened its ports, dismantled collectivized agriculture, and allowed market forces to operate under tight state supervision. Western corporations rushed in, drawn by low wages, disciplined labor, and government-backed infrastructure. What followed was an industrial migration on a scale never seen before. By the early 1990s, factories that once operated in Ohio, Michigan, California, and Texas now hummed in Shenzhen, Guangzhou, and Suzhou. Goods flowed east to west. Dollars flowed west to east. China accumulated trade surpluses year after year. And soon, Beijing faced a dilemma that textbooks rarely prepare countries for. What do you do when you earn more foreign currency than you can absorb? Letting the yuan rise would make exports more expensive, risking unemployment and social instability. Spending the dollars domestically would drive inflation. Hoarding cash would be inefficient and dangerous. So China chose the least disruptive path. It bought U.S. government debt. U.S. Treasuries were liquid, deep, and backed by the world's dominant military and economy. More importantly, buying them recycled dollars back into the American system, keeping U.S. interest rates low and consumer demand high. This was not charity. It was strategy. Each treasury purchase helped suppress the yuan's value. Each suppressed yuan made Chinese exports cheaper. Each cheap export reinforced China's manufacturing dominance. A feedback loop was born. The dollar standard and the illusion of leverage. By the early 2000s, China's reserves exploded. In 2001, China joined the World Trade Organization. Exports surged. By 2008, China held over $1.9 trillion in foreign reserves. By 2013, the number crossed $4 trillion, with over $1.3 trillion parked in U.S. Treasuries alone. This is when the narrative of leverage began. Western commentators asked, "Does China now own America?" Politicians warned, "What if China dumps the dollar?" On paper, the threat seemed real. Treasuries are the backbone of the global financial system. They price mortgages, corporate loans, derivatives, and sovereign debt worldwide. A sudden sell-off would spike yields, crash bond prices, and ripple through every asset class. But markets are not static weapons. They are reflexive systems. Selling at scale collapses price. Collapsed price destroys the seller. This is where leverage turns into liability. If China sold hundreds of billions in treasuries, prices would fall instantly. The remaining holdings, still massive, would lose value in real time. Losses would not wait until the last bond sold. They would occur immediately. And China's exposure was no longer limited to treasuries. By the 2010s, Chinese state institutions, banks, and sovereign funds held U.S. corporate bonds, mortgage-backed securities, dollar-denominated equities, dollar-based reserves underpinning the yuan. The dollar was no longer an asset class. It was the foundation. The global financial crisis was the moment the trap revealed itself. As U.S. banks collapsed in 2008, Beijing watched nervously. Its largest asset, U.S. debt, was suddenly at the center of the storm. But instead of default or collapse, the United States did something unprecedented. It printed. The Federal Reserve launched quantitative easing on a historic scale. Trillions of dollars were created to stabilize markets, buy treasuries, and support asset prices. China learned two lessons. First, the U.S. could expand its balance sheet without immediate collapse because the dollar was global reserve currency. Second, when panic hits, the world doesn't abandon treasuries. It runs toward them. China increased its holdings after 2008, not because it trusted American policy blindly, but because there was no alternative large enough, liquid enough, or credible enough to replace it. At the same time, Beijing began planning an escape. Not an exit. A slow unwind. Why dumping fails. The mechanics of self-destruction. To understand why China cannot dump the dollar, we must follow the chain reaction. Step 1. Treasury liquidation. China sells hundreds of billions in treasuries. Prices fall. Yields spike. Higher yields mean higher mortgage rates, higher corporate borrowing costs, and falling asset prices in the U.S. economy. But simultaneously, Step 2. Dollar depreciation. Large-scale selling weakens the dollar on foreign exchange markets. Now China's remaining dollar assets, still worth trillions, lose value. A 30% dollar decline wipes out roughly $750 billion from China's reserves. This is not theoretical. It is arithmetic. Step 3. Currency shock. As dollars flood markets, the yuan rises sharply. A stronger yuan makes Chinese exports more expensive globally, especially in the United States, China's largest export destination. Factories lose orders. Margins vanish. Employment drops. Step 4. Corporate debt crisis. Chinese companies carry trillions in dollar-denominated debt. A rising yuan increases the local currency cost of servicing that debt. Suddenly, loans that were manageable become unpayable. Default spread. Banks absorb losses. Credit tightens. Step 5. Energy and commodity shock. Oil, gas, and industrial commodities are priced in dollars. Currency volatility drives import costs higher in yuan terms, squeezing manufacturers already under pressure. The result is systemic stress, not in isolation, but across trade, finance, employment, and social stability. The U.S. suffers. China fractures. The export dependence problem. Unlike the United States, China's economic model remains deeply export-oriented. Even after years of rebalancing, exports and trade-linked investment remain critical to employment and growth. A sharp yuan appreciation would devastate. Coastal manufacturing hub supply chain cluster small and medium exporters migrant labor employment. The social implications matter. China's political stability rests on economic continuity. Growth slowdowns are manageable. Sudden dislocation is not. This reality places a ceiling on financial aggression. The more China integrated into global trade, the less room it had to weaponize that integration. The slow unwind. China's quiet strategy, 2009 to 2025. Instead of confrontation, China chose gradualism. Treasury holdings peaked around 2013, then began a long, careful decline. By July 2025, holdings fell to $731 billion, the lowest since 2009. Not a fire sale, a drip. Simultaneously, China diversified. Gold purchases accelerated. Official reserves rose steadily, while analysts suspected off-balance sheet accumulation. Domestic mining expanded. Strategic stockpiles grew. Alternative infrastructure emerged. The Cross-Border Interbank Payment System, CIPS, reduced reliance on SWIFT. Bilateral currency swaps bypassed the dollar in regional trade. Energy deals settled in yuan appeared with select partners. Yet progress remained slow. Why? Because liquidity matters. Gold is a hedge, not a settlement system. Regional currencies lack depth. Capital controls limit yuan globalization. The dollar system persists not by coercion, but by scale. Mutual dependence, not mutual trust. By 2025, the relationship is no longer cooperative, but it is still interdependent. The U.S. relies on global demand for its debt to finance deficits. China relies on dollar stability to preserve its accumulated savings. Neither side trusts the other fully. Neither side can disengage abruptly. This is not Cold War rivalry. It is financial entanglement, a structure built not by conspiracy, but by incentives. Every actor optimized for short-term gain. The system optimized itself into rigidity. The real danger is not that China dumps the dollar. The danger is that no one controls the system anymore. Debt levels rise. Political fragmentation grows. Sanctions turn finance into warfare. Supply chains decouple unevenly. Stress accumulates. And when stress releases, it rarely follows scripts. The dollar trap is not unique to China. China is simply the largest prisoner. This story is not about villains or heroes. It is about architecture. A financial structure built over decades brick by brick, now too large to dismantle without collapse. China's $3.2 trillion is not leverage. It is gravity. And gravity does not negotiate. In the final chapter, we confront the implications what this trap means for the future of money, power, and the fragile equilibrium holding the global economy together. The most dangerous systems are not the ones built to dominate. They are the ones built to function quietly, efficiently, invisibly until no one remembers how deeply they depend on them. The global dollar system was never designed as a trap. It emerged from necessity, habit, and scale. One country consumed, another produced. A currency lubricated the exchange. Over decades, efficiency hardened into dependency. Dependency matured into entanglement. And now, that entanglement defines the limits of power. China's $3.2 trillion in U.S. dollar exposure is not an anomaly. It is the residue of 40 years of trade surpluses, policy decisions, and strategic compromises. It represents factories built, workers employed, infrastructure financed, and growth sustained. It is history converted into numbers on a balance sheet. But history does not unwind cleanly. Every mechanism revealed in this story points to the same conclusion. There is no dramatic exit. No financial button that can be pressed without consequence. The so-called nuclear option exists only in theory. In practice, it vaporizes the holder first. Selling treasuries collapses their price. Weakening the dollar erodes remaining reserves. Strengthening the yuan cripples exports. Triggering defaults fractures banks. Destabilizing energy imports squeezes industry. Each step feeds the next. This is not speculation. It is structure. And structure resists sudden change. The United States, for its part, is not immune. Its reliance on global demand for debt has shaped domestic policy, distorted incentives, and normalized deficits once considered unthinkable. Cheap borrowing delayed reform. Consumption replaced production. Financial markets grew larger than the real economy they were meant to serve. The dollar's dominance has been a privilege, but also a temptation. Print when stressed. Borrow when constrained. Defer cost to the future. These habits accumulate consequences of their own. What emerges is not a story of one nation holding another hostage, but of two giants bound together by the same rope, each pulling in opposite directions, neither able to let go. This is the hidden truth of modern financial power. Interdependence reduces freedom. The more integrated a nation becomes into the global system, the less room it has to act unilaterally. Leverage transforms into exposure. Scale transforms into inertia. China understands this. That is why its strategy has never been rupture. It has been repositioning. Gold accumulation was not a bet against the dollar. It was insurance against disorder. Alternative payment systems were not replacements. They were pressure valves. Treasury reductions were not rejection. They were risk management. Domestic consumption was not isolation. It was resilience building. Each move was incremental, because anything faster would be destabilizing. But slow exits face a problem of their own. Time allows systems to adapt, but it also allows pressures to build. Demographics shift. Debt compounds. Politics harden. Technology reshapes production. Trust erodes. The question is no longer whether China will dump the dollar. The real question is whether the system itself can evolve before stress overwhelms it. Because history shows that financial orders do not collapse the way movies depict, overnight, in flames and chaos. They fracture gradually. Liquidity thins. Confidence wavers. Correlations break. What once moved together begins to pull apart. Then, suddenly, something that seemed impossible becomes unavoidable. The British pound did not vanish in a single year. The gold standard did not end in one decision. Empires did not fall at their peak, but after long periods of overextension and rigidity. The dollar system is not collapsing today, but it is aging. And aging systems become less flexible, less forgiving, and more sensitive to shock. China's dilemma is not unique. Other nations face the same paradox on smaller scales, holding assets they cannot liquidate, relying on systems they distrust, operating within rules they did not design but cannot escape. This is what global finance has become, a web of mutual constraints. The irony is sharp. The system that allowed China to rise now limits its options. The system that empowered American consumption now restrains American policy. And the currency that promised stability now concentrates risk. No one is fully in control. That realization changes how we interpret power. True power is not the ability to destroy a system. It is the ability to adapt when destruction would be self-inflicted. In this sense, restraint is not weakness. It is recognition. The future will not be decided by a dramatic sell-off, a sudden announcement, or a single geopolitical event. It will be shaped by quieter forces, rebalancing, diversification, technological change, demographic pressure, and political will. Whether those forces produce a smoother transition or a more volatile reckoning remains unresolved. But one thing is clear. China's $3.2 trillion is not a threat hanging over the United States. It is a mirror reflecting the deeper truth that the modern world is bound together not by ideology, but by ledgers. And ledgers remember everything. As long as this system endures, neither side can move without affecting the other. The trap is not that China holds too many dollars. The trap is that the world built a financial order so vast, so interconnected, that escape itself has become the greatest risk. The question we are left with is not who will pull the trigger, but whether the system can be reimagined before gravity does the pulling for us. If you want to understand the future of power, currency, and global stability, you must first understand this paradox. Because, in the end, the most powerful force in global finance is not money. It is dependency.